George Bailey is a community banker who faces a room full of panicked customers who think that his small-town bank is going to fail. They're threatening to withdraw their savings, but the bank, which pays interest on those savings and then lends that money to others to buy things like houses, doesn't have enough cash on hand to refund all of its depositors. So George convinces the depositors to accept a smaller amount, which he covers personally. And that is the famous bank run scene from the 1946 classic, It's a Wonderful Life.
Don't you see what's happening? Potter isn't selling, Potter's buying. And why? Because we're panicky and he's not. That's why. He's picking up some bargain. Now, we can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money.
How am I going to live until the bank opens?
I got doctor bills to pay. I need cash.
I can't keep my kids on faith. I've got to have...
How much do you need?
Hey! I got $2,000. Here's $2,000. This will tide us over to the bank reopen.
Now, I'm not just playing that clip because it's a Christmas classic. It's also a perfect depiction of a bank run. And it underscores the role of the FDIC, or the Federal Deposit Insurance Corporation. And some on the Trump transition team could learn a lesson or two from it. The incoming administration has reportedly started looking at ways to drastically shrink, consolidate, or even eliminate the top bank regulators in Washington. According to the Wall Street Journal, quote, in recent interviews with potential nominees to lead bank regulatory agencies, President-elect Donald Trump's advisors and officials from his newfound Department of Government Efficiency have, for example, asked whether he could abolish the Federal Deposit Insurance Corporation, end quote. Let me tell you why this is a really bad idea. The FDIC was created during the Great Depression after thousands of banks began to fail. Many Americans lost their savings. Those who didn't lose their money right away panicked and withdrew their deposits, causing what's known as a bank run and causing more banks to close. That scene in It's a Wonderful Life was familiar to many Americans back then. Today, it's more difficult for most of us to relate to that movie scene, and that is thanks to the FDIC. The agency was created to restore and maintain the public's confidence in the financial system, and it worked. The FDIC began insuring banks in January of 1934, creating stability in the banking system. Banks and savings associations would basically pay small premiums for deposit insurance companies by the FDIC. It's called an insurance corporation. At the end of 1934, only 9 banks had failed compared to the more than 9,000 banks that had failed in the previous 4 years. Today, the broad purpose of the FDIC is to protect your money in the event of a bank failure. It does so through deposit insurance. The FDIC insures trillions of dollars in deposits at almost every major bank and savings association in the United States. The agency will insure at least $250,000 per depositor at FDIC-insured banks. Since its creation, no American banking consumer has lost money that was in an FDIC-insured account, even when the bank fails. The FDIC has also kept an eye on financial institutions to make sure that things are operating soundly and consumers remain protected. And if a bank does fail, the FDIC runs point on that, too. It works to find a solution for the banks and limits the effect that a bank failure might have on the broader economy. It was common during the Great Recession for a bank to fail and shut its doors on a Friday, for customers to have access to their funds from an ATM over the weekend, and for the bank to reopen under new ownership on a Monday morning, all courtesy of the FDIC. Sheila Bair, former FDIC chair during that Great Recession, when some major American banks failed, says if the agency were to shutter, it would be a big mistake. She says, quote, FDIC has a perfect record of protecting insured deposits for over 90 years. Treasury has no expertise in handling bank failures. Changing the guarantor would create confusion among depositors who are comforted by the FDIC insured sign at their banks, end quote.